Okay, now let's see a few amendments which has been made in the exemptions. And first notification that we are going to see is number 28 by 2018, which has made a few amendments, and then there is another notification of 2019. Okay, so 21B has been inserted. Now what you have to do is read them separately, but when you will revise them, revise along with the serial numbers if you want to, though there is no necessity for that. So what 21B says: services provided by a goods transport agency by way of transport of goods in a goods carriage to department or establishment of the central government or state government or union territory or local authority or governmental agencies which has taken registration under the Central Goods and Service Tax Act of 2017 only for the purpose of deducting tax under section 51 and not for making any taxable supply of goods or services. Now what this means is that if a goods transport agency provides service to these entities, okay, as we have seen earlier in many discussions, that goods transport agency providing service to registered persons is taxable, right? And there is a reverse charge mechanism also for that. But if the goods transport agency provides service to these people who are registered not because they supply taxable services or goods, but because they are required to deduct tax at source under section 51. So any person who is required to deduct tax at source, though we'll see what is the meaning of TDS, you will not understand right now, so forget it. But these entities, the government departments and all, they are required to deduct tax at source, and because of that they require registration. And as they require registration, if a GTA provides service to them, it will become taxable. So government said that okay, this is a very complicated matrix, let's cut it down. So they have exempted it. So service provided by a GTA to these entities would be exempt if they are registered only for deducting tax at source. But if they are registered because they provide taxable services or taxable goods, then the GTA service would be taxable. Okay. And the same amendment we had seen in RCM also. The same thing, that if GTA provides service to these entities, then it will not be liable for RCM. No reverse charge mechanism. Then next is 27A is also inserted. Services provided by banking company to basic saving bank deposit account holders under Pradhan Mantri Jan Dhan Yojana. These are small account holders, so if services are given to them, then they will be totally exempt, not of much use. Then there was a clause 67 which has been omitted. It was for IIMs. Services given by IIMs were exempt, PG diploma courses and all, but now it has been removed, means they are taxable. So all kind of education provided by IIMs is taxable now. Then 74A has been inserted. Services provided by rehabilitation professionals. Rehabilitation professionals means people who work in rehabilitation programs, recognized under the Rehabilitation Council of India Act of 1992 by way of rehabilitation, therapy or counseling and such other activities as covered by the said act at medical establishments, educational institutions, rehabilitation centers established by central government, state government or union territory or an entity registered under 12AA of the Income Tax Act. So a lot of rehabilitation centers are there, and if you are a professional who are working there in the rehabilitation center, then the services that you give there will not be liable to GST. Simple one. Again, not of much use, I would say. Then following further exemptions have been added by notification number 4/19 to notification number 12/17. So notification 4/19 with effect from 1/4/2019. Basically 41A, 41B has been inserted, and these are for real estate transactions related to real estate. So you have to just read it once and leave it, because it is not in course. Okay, so read once just for overview, and then you can leave it. So what it says, service by way of transfer of development rights, that is TDR, hereinafter called as TDR, transferable development rights. That is, if I have a land and I give you the development rights for developing, building on it, and then we will sell it to the prospective buyers. Or floor space index, FSI. I am transferring FSI. I have got land and I have got a building also, but there is FSI remaining, so I am transferring you the FSI to construct the property and sell it off, including additional FSI. On or after 1/4/2019 for construction of residential apartments by a promoter in a project intended for sale to buyer, wholly or partly, except where the entire consideration has been received after issuance of completion certificate where required by the competent authority, or after its first occupation, whichever is earlier. Now this point we have discussed earlier also many times. Now here I'll relate this TDR and FSI with the construction service and see how it correlates to each other. So what it says is, if you read it once again, the person is transferring development rights. The person, the assessee, is transferring development rights or FSI. To whom? To a promoter. Okay. For construction by a promoter means we, the landowner, is transferring the development rights or the FSI to the promoter, who is going to develop the property, and then he's going to sell it to the public. Now the point is that when I am transferring this development rights or FSI to the promoter, okay, then whether my transfer is taxable or not depends upon the promoter. Then when is the promoter ultimately going to sell the flats? Is he going to sell them before the completion certificate, or is he going to sell them after the completion certificate is obtained, or the occupation, whichever is earlier? Okay, so it says intended for sale to buyers, wholly or partly, except where, it says except where the entire consideration has been received after issuance of completion certificate. So here exception means what? Taxable, because the original thing is exemption. So exception to exemption means taxable, right? So let me explain with correlation, so then you'll understand. Now in this whole construction industry, as I had explained you earlier also, that the promoter, also called as a builder in common language, he promotes a scheme like flat scheme. Okay, and in this flat scheme, if I say the completion certificate or the occupation, the first occupation is on 13th of January 2020. Okay, 13th of January 2020. Now to construct this scheme he needs the land, so there is a land owner, the landlord, who transfers the TDR or FSI to the promoter. So giving the TDR or FSI to promoter is itself a service. This is taxable, and the promoter is going to construct, so his construction service is also taxable. Okay, now when is this construction service? So promoter is going to ultimately sell the flats to the sale of flats to the buyers. Okay, so there are two transactions, the landowner giving FSI or TDR to the promoter, and similarly in the next point we'll see, that is long-term lease of exceeding 30 years, equal to or more than 30 years. So that is also covered. So let me explain it here itself, in this point itself. So there are three things: TDR, FSI and lease. So the landowner gives any of these three things to the promoter. So this is one service, and then the promoter sells the flats. Promoter selling the flat, this is called as a construction service, right? This is the construction service. Commonly known as a construction service, and this is TDR, FSI and lease. Now, when is this construction service taxable? When the entire consideration or part of the consideration is received before the completion certificate, right? So this construction service is taxable if consideration is received. So I'll say sale, okay? If sale is before CC or O, that is occupation, then this is taxable, okay? And if the sale is completely, means entire consideration, so sale means consideration, entire consideration is received after completion certificate or occupation is received, then this is not taxable, right? There are two things as far as the construction service is concerned, okay? If the sale takes place, means sale means part or whole of the consideration is received before completion certificate or the first occupation, whichever is earlier, then it is taxable. The construction is taxable. So if this construction is taxable service, then in this case, this service which is given TDR or FSI or lease by the landowner to the promoter will be exempt. So this service is exempt if that sale is going to take place before completion certificate or the occupation. Simple now, because this value of land is included there. So if the flats itself are taxable, the construction service itself is taxable, then this becomes exempt. And if that is not taxable, then this is taxable. Okay, so then TDR, FSI or lease will be taxable if the flat itself is not taxable. Okay, if the construction service is not taxable, then TDR, FSI will be taxable. Okay, and two more points I'll explain together, that we have seen RCM also. So in reverse charge mechanism also, who is going to pay tax on these? Who is going to pay tax on this when this is taxable? Who is going to pay tax? The promoter only. So this is taxable on reverse charge mechanism. So it is taxable under reverse charge mechanism, and that we saw earlier. And on which date? What is the date of taxability? This we'll study later on. Taxability in the procedural chapters, and that is when the completion certificate or occupation is granted. We will see much later in the chapter of payment of tax that when does the liability arise on this TDR, FSI or lease. So TDR, FSI lease is given in a very early instance. I give TDR to the promoter, then promoter constructs the scheme and then he sells the scheme. So completion certificate is much later, but taxability arises when the completion certificate or the first occupation takes place, whichever is earlier. And who is going to pay tax? The promoter himself. And what will be the value? So we'll see the valuation also. What will be the value of this? Value will be equal to the see what happens is, I'll tell you that when this person, when the landowner gives the TDR, FSI or lease to the promoter, if he takes cash consideration, then of course that cash consideration is taxable. Whatever cash he takes will be taxable. But normally they don't take cash. the landowner will take some flats in return. So he says, okay, give me 30 flats. I'll give you the right to construct on my land, or I'll give you the FSI, or I'll give you the long-term lease, and in return I want some part of the property, that is a few flats. So in that situation, what is the value? So value will be the equivalent value of flats at that point of time. Whatever flats the promoter is going to give to the landowner, suppose 30 flats are going to be given, then we'll value those 30 flats at the rates prevailing at that point of time, that is at the time of completion certificate. Understood? So we'll see that at the time of completion certificate, I am selling the builder is selling few flats in the market now. 30 flats are given to the landowner. The remaining flats are sold in the market. So what is the price at which I am selling in the market? That will become the value. Good. So a lot of points you have learned. All the related points which we'll see at different places. So that was 41A first. And then it says the amount of GST exemption available for construction of residential apartments in the project under this notification shall be calculated as under. Now see the exemption. Now what this is saying, that if the total project is not fully residential, it may happen that the project is residential as well as commercial, so part of it is commercial also, then exemption is restricted to residential portion, not for the commercial portion. So we'll divide it in this formula. Formula is the proportion formula. Carpet area will be seen. The total construction size is say 10 lakh square feet. Out of 10 lakh square feet is 2 lakh square feet is commercial. So 20% is commercial. So out of the total TDR value, 20% will be taxable always. Then it will not be exempt. Okay. So exemption is only for residential portion, not for commercial portion. So therefore this is given. GST payable on TDR or FSI, including additional FSI, or both for construction of the project, into multiplied by carpet area of residential apartments divided by total carpet area. So this will give us the exemption. So residential was say 80% of total. So 80% will become exempt, 20% that is for commercial purpose will become taxable. Simple. And provided that the promoter shall be liable to pay tax at the applicable rate on reverse charge, as I told you, reverse charge applies, on such proportion of the value of development rights or FSI or both as is attributable to residential apartments which remain unbooked on the date of issuance of completion certificate or the first occupation, whichever is earlier. Now this may also happen that some flats have been sold before completion certificate and some flats are sold after completion. So then what will happen? Whatever are unbooked, means unsold, that will become taxable later on now. As I told you, see what I told you, that if the flats have been sold before completion certificate, then this TDR FSI is exempt. So TDR FSI is taxable when the flats are going to be sold after completion certificate. So now I'll give you another example, that this is a complete land of which TDR or FSI or lease also we are going to see more than 30 years is given by the landlord to the promoter. Okay. Now in this scheme, in this whole scheme, 30% is going to be commercial, 70% residential, and out of 70%, half means 50% of 70 means, can I write 35-35 or I can write 50-50, it's same. So out of 70, 30 or let's say 30% are sold before completion certificate or first occupation, and the balance 40% remain unsold. So they are meant to be sold afterwards. Remain unsold at the time of completion certificate or the first occupation, whichever is earlier. Okay. So what will happen? That if this total TDR FSI value is say 1 crore, if the total value of TDR FSI is say 1 crore, then what will happen? The proportion for, we'll divide this total value in the same proportion. So 30% will mean 30 lakhs for commercial. This 30 lakh for commercial will be fully taxable, and it will be taxable on reverse charge basis. Then the remaining 70% is residential. Out of that, 30% is in relation to flats sold before completion certificate, means another 30 lakhs here. This 30 lakhs will become exempt, okay, because the construction service is going to be taxed. So this will become exempt, TDR will become exempt, and 40 lakhs in relation to the flats which have not been sold, that is in stock, which are to be sold later on. This will become taxable. So this is how the proportions will be calculated. Very simple. So when you see the mathematical formula written in English language, you feel jittery, but it is simple. So apply the logic and it becomes very simple. Take this down. Okay, great. So come back. So that is given here in this proviso. Provided that the promoter shall be liable to pay tax on reverse charge at the applicable rates. Rates are not in our course, so forget the rates. On such proportion of the value of development rights or FSI, or both, as is attributable to residential apartments which remain unbooked, means which remain unsold, means the entire consideration is going to be received after completion certificate, okay, in the following manner. So again the formula is given. So this is that percentage formula that I just showed you. GST on TDR FSI or both for construction of residential apartment into carpet area of residential apartments in project which remain unbooked on the date of issuance of completion certificate divided by total carpet area of the residential apartment. So first you divide between residential and commercial, and then within residential you have to further divide into in the proportion of carpet area for the flats which have already been booked, sold for part or whole consideration before the completion certificate, and what remains. And dividing, the ratio will always be calculated on the basis of carpet area. Okay, very simple. Provided further that the tax payable in terms of the first proviso herein before, herein above, shall not exceed 0.5%. This is the upper limit of tax payable, okay, shall not exceed 0.5% of the value in case of affordable residential apartments. Affordable means that low cost housing, 0.5%, and 2.5% of the value in case of residential apartments other than affordable residential apartments remaining unbooked on the date of issuance of the completion certificate or the occupation, whichever is earlier. The liability to pay central tax on said portion of the development rights or FSI of both calculated as above shall be arise on the date of completion. This also I told you, on the date of completion. The liability arises on the date of completion or the first occupation, whichever is earlier, okay, and reverse charge applies. So this is the upper limit, 0.5% for affordable housing and 2.5% for other residential apartments. But there is no limit for commercial. For commercial there is no limit. Means limit will apply in which case? As I told you, this 30 lakhs is for commercial, this is fully taxable. But for this residential 40 lakhs that we have made taxable, there is limit. So normally what we'll do is, as we know, the value of TDR is 1 crore and 40 lakhs is for those flats. So we'll calculate normal tax on 40 lakhs and then compare it with 0.5% of the value of the flats, the total value which has been given. So 0.5% for affordable and 2.5% for other residential apartments, and then pay whichever is less. Okay. And at the last it is given value of supply of service by way of transfer of development rights or FSI by a person to promoter against consideration in the form, see, consideration in the form of residential or commercial apartments. Means I am giving you the right to develop and I am taking back a portion of the property, 70 flats, 30 flats or some area, carpet area in commercial premises, shall be deemed to be equal to. So how to value it? Deemed to be equal to the value of similar apartments charged by the promoter from the independent buyers nearest to the date on which such development right or FSI is transferred to the promoter. So if they are giving me 30 flats on a particular date, then we'll see at what price he is going to sell similar flats to independent buyers. That value will become my value. Simple. Okay. So that is the whole 41A, and on the same lines is the next one. Upfront amount, that is called as premium or salami or cost or price or development charges or by whatever name, payable in respect of service by way of granting long-term lease of 30 years or more on or after 1/4/19 for construction of residential apartments by a promoter. Same to same as 41A. Only thing is here it is talking about the lump sum amount which is received on long-term lease. So I have a land, I am giving it to you on lease and I charge an upfront amount. Upfront amount is a capital amount that I charge. Okay, so it will be calculated in the same lines, absolutely same lines. If it is for commercial purpose, fully taxable. If it is for residential purpose and the flats are being sold before completion certificate, then it is exempt. And if they are the flats remain in stock, then this is taxable to that proportion, in that proportion. Okay, so no need to read this whole thing again. It is absolutely same as TDR and FSI. And then coming ahead, now see this point, an apartment booked. Now this is common for both. Okay, an apartment booked on or before the date of issuance of completion certificate or the first occupation shall mean. So we say now that apartment is booked before or booked after. So how can we say that it is booked before or after? So it says it will be deemed to be booked before the completion certificate if following three conditions are satisfied. Number one, part of the supply or construction of the apartment service has time of supply, TOS, time of supply. So we'll apply the rule of time of supply, okay, as per the chapter of time of supply that we are going to see after this. We'll see place of supply and then we'll see time of supply. So it says that even for part of the construction service, the time of supply should be on or before the said date. The time of supply should be on or before that said date. Said date means the date of occupation or clearance, completion certificate. Then consideration equal to at least one installment has been credited to the bank account of the registered person on or before the said date. Means at least some consideration should have been received by the promoter. Registered person here means the promoter. So promoter should have received at least one installment, means part of the consideration. If whole is received, very good. At least some amount should have been received before the completion certificate. And an allotment letter or sale agreement or any other similar document evidencing booking of the apartment has been issued on or before the said date. So an agreement to sell or an allotment letter must be made before the said date. So three things should happen. Time of supply should happen before the said date. At least some amount should have been received, and agreement to sell or any other document evidencing the agreement should be made before the said date. Said date means completion certificate or occupation, whichever is earlier. So that is simple. And at the last it is given that above services, the 82 that we saw first, not 82, many are there because of A, B, C, D also, have been exempted from both CGST and IGST by virtue of notifications issued under respective acts. So all these exemptions that we saw, first 82 and then these two amendment notifications, are exempted simultaneously in CGST, SGST as well as IGST. So though we have studied CGST exemptions, but they are common for SGST also and IGST also. Okay, great. So here we'll take a break, and then there are few additional exemptions in IGST which are not there in CGST, SGST. They are specifically for IGST, mostly related to import, export and all. So that we'll discuss in the next lecture.